Hey everybody, welcome to Money's No Object. I'm your host, Dylan Howell. This is episode number 404 of our YouTube channel and podcast, and I cannot be more excited to continue sharing with you guys personal finance topics that I think could be useful for you in your long-term financial journey. Today, we are going to be talking about investment accounts, right? And specifically, I want to talk about investment account types and the ones that you should know and that you should be able to keep track of, because it's not always about what you invest in as far as your investments themselves, but it's the shell. It's about where you put your investments, what types of accounts, and that can be very, very valuable and important to you over a long period of time. So stick around for a discussion of all that and more in today's episode. Before we get started though, if you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. Then if you need somebody to help you to build a financial plan and keep you accountable to that plan over the long term, then I can do that. Just DM me on any of the major social media sites and tell me that you are interested in financial coaching sessions, and you and I can begin working together, pushing towards your long-term financial goals and ultimately pushing you on towards long-term financial freedom, which is what I hope for every single individual who's watching or listening to this show on a day-to-day basis. Now, I talk about the importance of investing on this show quite often, right? And I talk about being able to compound your money and pick the correct investments that work for you and the different strategies that work for you and all these different types of things, right? And I talk about growing your money, and I talk about dividends and reinvesting. I talk about all these things, right? And ultimately, there's maybe an even more important aspect to investing than exactly what you invest in, right? And that aspect is what type of investment accounts you're using, right? And this is not something that a lot of people take into account. And this is very clear nowadays by all the people who jump into, Robinhood accounts or Webull accounts or whatever, and they're just buying stocks, and they don't really understand what's going on there and what type of account they have or whatever. They just think, hey, it's an investment account. And it is an investment account. But there are so many different types of investment accounts, and they have different uses. They have different advantages, disadvantages. They have different, value propositions that they can bring to you as an investor. So you need to know what the different account types are. And obviously today, I'm not going to cover every single type of account there is out there, right? But I want you to know some specific types of accounts that can be valuable to you. And if nothing else, raise awareness for you about the fact that when you go to invest, it's not just in one specific type of account, right? There are several different types of accounts that can be valuable, that can be useful, or that can possibly hinder your investments in a way that you may not want them to. So we're going to talk about multiple account types today, and there are several subcategories to these major categories of account types that I'm going to give. But you can look into those on your own. I just want you to be aware, right? So the first type of investment account that there is out there is just the standard brokerage account, right? Sometimes called a taxable brokerage account or a non-retirement account. Now, what this will do is this will provide you a broad range of investment choices, right? You can invest in almost anything within these types of accounts. Now, this would be the type of account that you would generally open if you open a Robinhood account or a Webull account, or if you invest via Cash App or whatever else. It's going to be used like a standard brokerage account, okay? And you can open one of these with any investment company, right? They will offer you just a standard brokerage account. And these are really, really simple, right? It's really simple. You invest in whatever you want to. You can put as much money in as you'd like. You can take as much money out as you'd like. It is very simple, and it can be done in an individual way or a joint way, right? You can have one just by yourself, or you can have one, let's say, with your spouse, right? You can have standard brokerage accounts in this type of way. Now, the kicker to a standard brokerage account is that any interest, dividends, or gains on the investments will be subject to taxes in the year that money is received, right? That's why it is called a taxable brokerage account because your gains are taxable. Okay. Now, obviously, this is realized gains, not just gains in general, but realized gains. Now, what do I mean? Well, gains will just be any gain that you have, right? Any, let's say, increase in value of a stock, right? That is a gain. Let's say you still hold that stock, you haven't sold it, right? Well, then it's not a realized gain. So you haven't realized the gain on that stock, so you don't have to pay any taxes on it. But once you realize the gains, meaning sell the stock, right, and actually make that gain, then you would be subject to taxation. Now, of course, interest and dividends, those will get paid and you will have to pay taxes on those as well. Now, the way that this works as far as capital gains is that if you make some gain over the course of a year, then you obviously sell whatever it is, you make the gain, then you have to pay your personal income tax rate on that gain, right? But if it is a long-term gain, so more than a year, right, that you hold this asset and make the gain, then you pay the capital gains tax rate, which can range anywhere from 0 to 20%. Right? But regardless, you will pay taxes on the gains. Now, similarly, right, if you take a loss, then you can deduct from your taxes a loss. Now, any loss that you have in a taxable brokerage account that gets realized, again, a realized loss, will offset any realized gains, right, up to however much you have in realized gains, right? And then once it offsets those gains, or if you have no gains to offset, then it can offset up to $3,000 of taxable income over the course of a year, right? So not only can a taxable brokerage account be used in order to, have you pay more taxes on your gains, but you can also get some tax breaks on any losses that you may take. Now, obviously, none of us want to take losses because we're moving in the wrong direction, but you can get a little bit of help on the fact that, hey, I took a loss on these investments. Now, when you open a brokerage account, the firm will likely ask you whether you want a cash account or a margin account. A cash account is appropriate for the majority of investors. It allows you to buy investments with money you deposit into the account. A margin account is for investors who want to borrow money from the broker to buy investments. Margin trading is a riskier type of investing that is best suited for advanced traders or best suited for absolutely no one at all, right? Margin trading, margin investing is one of the many things that I think is wrong with our investing system, because anytime you're taking out loans because basically that's what margin investing is, right? You're taking out a margin loan. You have borrowed money that you're using to invest. Anytime borrowed money is being used to invest, that just accelerates everything, right? Yes, it can accelerate gains, but it can just as easily accelerate losses, which is a problem, right? So not a big fan of margin accounts. Get cash accounts, right? Now, to be eligible for a taxable brokerage account, you must be a legal adult, at least 18 years old, have a social security number or tax ID number, and that's really it, right? It's very simple to open one of these accounts. Now, there are no limits, again, on how much money you can contribute or how much money you can take out at any time. Again, even though you may owe taxes on anything that you have a realized gain on if you take that money out. So that is the taxable brokerage account. It's very simple, very straightforward, nothing too crazy about the standard taxable brokerage account. But then there is this next category of investment accounts. And this next category is quite broad and is, from just an objective view, quite a bit more complex, right? There's far more rules associated, far more things that you need to know and understand via specific account types. And again, I'm not going to cover every single account type within this category, but I'll cover some of the major ones just so we have a general knowledge base here. So the second category is retirement accounts. So a retirement account, such as an IRA or individual retirement account, is a standard brokerage account with access to the same range of investments, right? So basically, with an IRA, it's very, very similar to a standard brokerage account. You can invest in many of the same things, right? Now, the difference is the tax treatment, right? The difference between a retirement account and a brokerage account is how the IRS taxes or doesn't tax contributions, investment gains, and withdrawals. Okay, so let's explain what we mean here. Let's just talk traditional IRA real quick. Okay, traditional IRA. You put money into a traditional IRA, right? What happens is you get a tax deduction for any money that you put into a traditional IRA, right? So it decreases your taxable income. So you get tax deduction. The money grows tax deferred, right? So any buying or selling that you do within a traditional IRA or a Roth IRA for that matter, but we'll get to that in a second. Any buying or selling that you do, realizing of gains, there will be no taxes on those gains. You will defer those taxes to the end of the line. You will defer those taxes until you take that money out. And then you won't be paying taxes on the gains. You'll be paying taxes on just the withdrawal itself at your income tax rate. So you get a tax deduction for the money you put in. You grow the money, tax deferred, and then ultimately when you withdraw the money, you pay taxes on that money, right? You pay your income tax rate on that money. And so this is something that can be valuable, obviously, because you save on taxes here, right? You save on the taxes that you would pay. Now, there's that traditional option, but there's also the Roth option. And so the Roth option is similar, but different, right? And I like the Roth option better for the vast majority of people. And here's why. Because the back end of the Roth option is different. Now, the front end is different as well, but the back end is, for most people, the most valuable part of it all. So with a Roth IRA, you're going to put in money that's already been taxed. So you're not going to get any tax deduction for putting money in. So that's already one knock against the Roth IRA. But then your money's going to grow tax-free, right? So in the same way, you have any gains along the way in a Roth IRA, you're not going to pay taxes on any of those gains, okay? Which is super valuable, right? And then later on, right, when you get to retirement age, which on both of these accounts currently it's age 59 and a half when you can take out your money without taxes, penalties, or anything like that. You reach age 59 and a half, you're taking money out of the Roth IRA, you take that money out tax-free. So not only does your money grow with no taxes, but then you can take the money out with no taxes, okay? Which is extremely valuable because we all would love income without any taxes, right? So the traditional and Roth IRAs, they're very similar in that. Now the traditional and the Roth IRAs, they're quite simple, but that's how they work, right? They give you these tax advantage. That's why in general, we'll call retirement accounts tax advantage retirement accounts or tax advantage investment accounts because they have these specific types of tax advantages. Now, traditional and Roth will most commonly be referred to in that way where one is tax deduction, tax deferred growth, and you take the money out, you have to pay taxes. That's traditional. And then Roth being after tax money invested, tax-free growth, and then taking the money out tax-free, right? Because these aren't going to just be associated with an IRA. They can also be associated with 401ks or 403bs, which are employer-sponsored retirement accounts. Okay, now, with the IRAs, there are contribution limits. Well, 401ks, 403bs, other types of employer-sponsored retirement accounts have higher contribution limits and no income limits in the same way that IRAs may. All right, so you can invest in a 401k, 403b, whatever, and that is just a way that you can defer some of your income from your job, right? And you can do so directly through your employer-sponsored plan. And they're very, very similar to an IRA, but something that a 401k or a 403b may allow you to do is they may allow you to get a matching contribution, which is, if you've listened to the show for any period of time, super valuable, right? And is the third part of the financial action plan. If you have an employer-sponsored retirement account, you want to always be taking at least the match from your employer-sponsored retirement account, if not far more. Now, with all of these types of retirement accounts, right, 401ks, IRAs, all these types of things, right, there is no such thing as a joint 401k or a joint IRA, right? All of these things are individual. They are for the individual. With the IRA, that's quite clear because individual is in the name, but with the 401k, 403b, it's all for an individual. Now, how are you eligible for any of these types of retirement accounts? Now, I only named a few. I named the IRA, the 401k, the 403b, because those are the most common types. But there are also SEP IRAs, simple IRAs, solo 401ks, all these different types of things that you can look up or that you can listen to old episodes on, but I'm not going to go through today. So how are you eligible for any of these types of accounts? Well, first of all, you must have earned income. And that's something that was not true of the brokerage account. You didn't have to have earned income. But with an IRA 401k, you do. Now, either you or your spouse must have a qualified earned income, right? So for instance, with an IRA, you could be, let's say, a stay-at-home mom, right? But let's say your spouse makes all the money for the family. Well, you could both have IRAs, even though you don't have earned income. If you are married, you file jointly your taxes, then you could both have IRAs that could both be maxed out over the course of the year, even though only one person actually brings home the income. But somebody must have an earned income to be eligible to contribute. Now, there are also income limits for contributing to the Roth IRA and for deducting contributions to the traditional IRA. So for the Roth IRA, there's income limits to how much you can make in order to put money in. And with the traditional IRA, the deductions on the contributions, because like I said, you get a tax break up front on the contributions, those go away after a certain amount of income as well. Now, the maximum individual is allowed to contribute to an IRA is $6,000 a year, or if you're age 50 or older, $7,000. And per IRS rules, there may be taxes and penalties for dipping into IRAs before age 59 and a half. So if you think you'll need access to the money early, the Roth IRA provides more penalty-free options, like being able to take out your contributions at any time, or even take out your earnings after a 5-year period, right? So this is important to note, and it's important to understand. So a retirement account is going to be something that's more long-term, that's going to have more restrictions associated, but there are going to be more benefits than just the taxable brokerage account as well. Now, what's another category of investment accounts? The third one that I want to talk about is investment accounts for education and for your children, okay? Now, we'll start kind of with education here, okay? The most common type of and popular type of investment accounts used for education is the 529 savings plan, right? Now, most states offer their own 529 plans that you can open directly, but typically the money can be used at eligible schools nationwide. Some brokerages also allow you to open 529 accounts. So for example, TD Ameritrade offers 529 accounts through Nebraska's plan, and Wealthfront offers through Nevada. Now, other education savings options are like the Coverdale ESA, Educational Savings Account. And an ESA must be set up before the beneficiary is 18. And like 529s, the money can be used for college, elementary, and secondary education expenses, right? Now, these are very, very common account types. The 529 specifically can give you some state tax breaks, right? So you can get some tax deductions on your state taxes, but you're setting up money that can grow in a tax deferred way or a tax-free way for your child or for whomever you're setting up an educational account for, whoever the beneficiary is. You set it up in that way, and then it can only be used for those specific types of withdrawals for educational expenses. Now, if whomever it is gets a scholarship, then you can take as much money out of that account as their scholarship is, right? You just have to have proof that it occurred. Now, to be eligible for these, relative or not, anyone can contribute to these plans, the ESA or the 529, on behalf of a beneficiary. And anyone can be named a beneficiary on the account as long as the money is used for qualified educational expenses. Contributions to 529s and ESAs are not tax deductible, though you might get a state tax deduction on the 529 contributions, but qualified distributions are tax-free. All right, so as long as you're making the distributions for qualified educational expenses, then it will be tax-free. Now, what about other investment accounts that you may use for your children, right? Well, there's the custodial brokerage account, which basically means that you are the custodian. You are the person that's overlooking the account for the minor child, right? So the investment account is set up for a minor with money that is gifted to the child. An adult, the custodian, maintains account control and transfers assets to the child when he or she turns the age of majority, which is either 18 or 21, depending on whatever state you live in. Two types of custodial accounts are the UGMA and UTMA. So UGMA is the Uniform Gift to Minors Act, and the UTMA is the Uniform Transfer to Minors Act. The difference is the type of assets you're allowed to contribute to the account. UTMAs are able to hold real estate in addition to the typical investments allowed in both types of accounts, which is like cash, stocks, bonds, mutual funds, all those types of things. And once the money is in the account, it cannot be transferred to another beneficiary. So this is something very important with a custodial brokerage account. Once the money is in the child's name, it is the child's money. It is no longer your money, whomever put the money in. It is the child's money, and you are just there to be the custodian of that money. So what's the eligibility here? Well, a child does not need to earn income for an UGMA. Some states allow UGMAs, some allow UTMAs, and some allow both. A broker can determine whether your state allows you to open one for a beneficiary. Now, unlike money in an education account, money put into an UGMA or UTMA can be used for any purpose, not just college tuition. And be aware that if the child applies for financial aid, the assets in the custodial account are considered the student's and can impact their eligibility and the amount of the aid package. Okay, so that's important to note if they wanted to take out any type of student loans or whatever, which hopefully they do not. Now, there's also the custodial IRA, which falls under this heading. So if your child has earned income, they're eligible to contribute to a Roth or traditional IRA. The account is set up and maintained by an adult who transfers it to the child when they turn 18 or 21, right? So the earned income can come from anything: babysitting, lawn mowing business, Instagram sponsorships, whatever, as long as it is reported to the IRS. And in a Roth IRA, contributions, but not earnings, can be pulled out at any time without incurring income taxes or an early withdrawal penalty. So for somebody so young, that may be something that is quite valuable. Okay, so those are the third type, right? Education and accounts for your children. Now, the fourth type that I want to talk about are health accounts, right? So health care investing accounts. And there are two major types, and the second of which I think is going to be the most valuable. But the first that I want to talk about is the FSA, or the flexible spending account. The flexible spending account is a type of savings account that provides the account holder with specific tax advantages. The FSA is sometimes called the flexible spending arrangement and can be established by an employer for their employees. The account allows you to contribute a portion of your regular earnings. Employers can also contribute to the employee's accounts. Distributions from the account must be used to reimburse the employee for qualified expenses related to medical and dental services. Another type of FSA is a dependent care flexible spending account, which is used to pay for child care expenses for children aged 12 and under, and can be used to pay for the care of qualifying adults, including a spouse who cannot care for themselves and meet specific IRS guidelines. A dependent care FSA has different maximum contribution rules than a medical-related FSA, right? So an FSA can be used for qualified medical expenses. It can have some tax advantages, but the important part with the FSA is that if you do not use it over the course of a year, then you end up losing it, right? Which is not super beneficial, but you put money away in it, you get tax advantages, and you use the money for your medical expenses. The more valuable would be the HSA, the health savings account. Okay, I have an HSA, tons of people have HSAs, but are you getting the most out of your HSA? Here's why I asked that, because an HSA works very similar to the FSA, right? You put money in, your employer can put money in, you can get a match from your employer for an HSA, all these types of things, and then it's used for qualified medical expenses. Now, is the HSA being used to its full potential? And the reason I ask that is because your HSA is what we call triple tax advantaged, okay? You put money in, you get a tax deduction, just like a traditional IRA, right? You get a tax deduction. You can invest that money within the HSA, and that money can grow and grow in a tax-free way, right? And then the distributions or withdrawals are also tax-free as long as they're used for qualified medical expenses. Or if you hold the account until age 65, then the HSA can become like a traditional IRA. Any money you take out then is taxable, but you can take that money out without penalty. So the HSA is extremely valuable. You get that triple tax advantage, right? And it can be invested, right? And the FSA in some cases can be invested as well. But the HSA, I would suggest, hey, get you an HSA that is invested. Now, the problem with both of these types of accounts is that you must qualify for them, especially the health savings, right? The health savings account is going to be predicated on the fact that your type of insurance, whatever type of health insurance that you have, is a high deductible insurance plan, and that is HSA qualified. And then you can put money into an HSA. Now, the beauty of an HSA, any money that you put in is going to be your money. You don't use it, you don't lose it, right? You can have that money as long as it is there. But you can only contribute while you are under the bounds of your high deductible healthcare plan. Okay, but you can continue having it for as long as you have that money there, and use that money as long as you may need it. Something else beautiful about the HSA is that, let's say you're an individual and you're on your own plan, and let's say your spouse and your children are on another plan that's not an HSA qualified plan. Well, you can take your individual HSA, even though you have lower contribution limits than a family HSA would have, but you can take your HSA and use it to pay for any qualified medical expenses of your children or your spouse, as long as you're married and they are your dependent children, right? So an HSA can be extremely valuable and works in similar ways to some of these other accounts, but it is super useful in its tax advantages and then its ability to pay for some medical expenses, which for many people can be extremely, extremely valuable, right? So those are the four types, the four categories of investment accounts you should know about, right? The standard brokerage accounts, the retirement accounts, the education and kid accounts, and then the healthcare accounts, right? And knowing where to allocate your assets, knowing how to allocate your assets over these different types of accounts is difficult, right? I would say that my wife and I contribute more money to retirement accounts than just about anything, but we do put money into standard brokerage accounts. We do put money into accounts for our son. We do put money into healthcare accounts, right? But just in lesser amounts than we do just the retirement accounts. Because ultimately, we need to take care of our own retirement, our own long-term future first. Then we can invest for other things. And that's what I would suggest to you. Take care of your future, take care of your long-term future in the best way possible, in the most tax-efficient way that you can, whether it's through Roth accounts or whatever else, right? And then invest for other things as the need comes along, right? Because obviously you don't have to invest for kids if you don't have kids, right? Or invest for things as you find it necessary or as you have the excess income in order to do so. But take care of yourself first. Take care of your long-term future first. Then start investing for other things like healthcare expenses, like your children, things like that. But ultimately, know these different account types and dig in a little deeper if you need to. I have some episodes out there on all these different types of accounts, and I dig in a little deeper in those episodes, and hopefully those can be a good resource to you as you move forward. But hopefully this was a good resource as to just understanding that there are different types of accounts out there that can benefit you in different ways, and you just have to be thoughtful about the choices that you make with the investments that you have. So thanks for watching this video. If you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan. And that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. Then if you need somebody to help you to build a financial plan and keep you accountable to that plan over the long term, then I can do that. Just DM me on any of the major social media sites and tell me that you are interested in financial coaching sessions, and you and I can begin working together, pushing towards your long-term financial goals and ultimately pushing you on towards long-term financial freedom, which is what I hope for every single individual who's watching or listening to this show on a day-to-day basis. So tune in tomorrow as I continue talking about personal finance topics that I think could be useful for you in your long-term financial journey. So thanks for tuning into this episode of Money's No Object. I'm your host, Dylan Howell. God bless.